Okay, it's October 18th, 2022. Tesla's stock price is right about $220. I've been following Tesla since 2007 and big fan of everything they've done. Right now is just about the most excited I've ever been about the company, both as just a general fan of what they're doing and also as a retail stock investor. In this video, we're going to go over how what Tesla really is, how it's more than just a car company, and hopefully by the end of the video, you see them a little bit more the way that I see them. I want to try to share my vision of their vision. Um, okay, so we're gonna look at the overview, the auto models, projections. We're gonna break apart the sky high PE ratio. This price to earnings, famously around 80. The production capabilities, some of their unique advantages. A look at the macro environment. Things that are important, but we're not going to get into in this video. Tesla's never spent a dollar on advertising. They've kind of revolutionized the auto industry with the software as a service and the over-the-air updates, specifically recalls. You see a lot of these Tesla recalls, 400,000 vehicles, but that's an over-the-air software update. They don't have to actually bring any vehicles to the store or do any maintenance or physical replacement or anything. It doesn't cost them anything. So anyway, Tesla has the best charging station infrastructure, and it's kind of, you could consider something analogous to gas stations in the gas station industry. They have always pursued vertical integration, which is trying to make as many of the parts involved in your thing as possible, trying to control every part of the supply chain all the way up and down from beginning to end. In the near future, in December, the electric semis are coming out. First set of deliveries to Pepsi of the electric semis. The autonomous vehicles, we'll a little bit touch on it, but not really. But Tesla has what I believe to be an unassailable lead in vehicle autonomy, just because every car they have on the road, which is over 3 million at this point, is collecting data. And as a machine learning problem, the more data, the better. So if anyone wants to try to compete with Tesla in this or beat them to the finish line of a fully self-driving car, they're going to have to find a way to generate more data than Tesla's fleet of 3 million vehicles. And I just don't see how that's possible. So also Tesla, has talked about potentially getting into mining, going all the way up the vertically integrated chain all the way to the source and getting into mining themselves. And I think that would be really exciting. And obviously, there's the Boring Company, is also a Musk company, and it seems that would a mile a day of electric tunnels for every machine seems like that could really revolutionize the mining industry. But I'm not going to talk about that stuff. We're going to start at the unit production. So basically, want to look on the left side. The top is unit production per quarter, and the bottom is cumulative vehicles on the road. So this yellow line is the Model 3 and Model Y deliveries. And as you can see, this is going up basically exponentially. Just a little comparison of Tesla's auto sales from Q1 2019 to Q2. So kind of throughout the pandemic, right, compared to some of the other autos. And then from Q1 2021 to Q1 2022. So Tesla's unit production is up 41%. Mini and BMW are also positive. Everyone else is negative. some of the big names, Ford and Chevy. So Ford down 17% in this time period, Chevy down 20%. Tesla, this is just demonstrating that because of the vertical integration, Tesla had a large advantage during when the supply chains were shut down, because Tesla had already brought as much of the supply chains in house as possible during the chip shortage. Tesla was able to pivot and redesign or rejigger some of their existing chips to do the job that needed to be done. So, I mean, this is the result of that agility and having brought the supply chains in house as much as possible, vertically integrating. Taken from the report, this is basically just to say that 80% of their Q2 2022 earnings was coming from auto sales, and their gross margin for auto sales has been increasing and is currently at 27.9%. Okay. So Tesla's sky high PE ratio. Okay. Everybody talks about, it doesn't make sense. It's overvalued. You need to buy, they're only making $80, what is it? You have to spend $80 to earn $1. It would take you 80 years to pay this off, right? So like this is the argument. The S&P average PE ratio is about 25. The auto industry is about 5, right? Ford is at 4 and GM is at 6, right? So in this case, the lower the better. But the thing is where this is kind of, let's break this apart because it's not quite ingenuous. So the large 80% number or 80 number is based on a trailing 12-month indicator, which means, so you have a factory ramping up. And I did a case study here, throughout 2021. So say this is the Shanghai factory ramping up. Okay, Q1, it's only at 10% production. Q2, it's at 25% production. Q3, it's at 40% production. And Q4, it's at 75% production. Okay, now at the end of Q4, let's try to calculate what is this worth now. Okay, is the way to do that, what did it make this year, right? Which is to add up the EPS for Q1, 2, 3, and 4, like here. And then if we do it that way, based on how much did they earn this year, right? Then that's a trailing 12-month indicator. And that price to earnings ratio is about 80, given the price, which is $352.26 at the end of Q4 2021. Now, to me, that doesn't make sense, right? This factory is already at 75% production, and Q1 2022, it's going to make at least as many as it did this quarter, right? So let's annualize their last month's production or last quarter's production and say, let's assume every quarter going forward is going to be at least that good, right? And when you're looking at a factory that's ramping up, I think that's the way to do it. So that's called an absolute PE ratio. If we calculate, if we take the Q4 earnings, multiply that by 4, and compare that to the price, now the absolute PE ratio is under 60. It's 57. Okay, and again, I just want to highlight this yellow exponential growth curve in the number of cumulative deliveries of Model 3s and Ys on the road. Okay, so Tesla, when you annualize that number to the absolute PE ratio, that's assuming we're going to keep doing what we did last quarter. It does not factor in additional growth. It doesn't assume, hey, we're growing at this rate what's that going to be? So I took this out. I assumed the auto margin stays the same at 27.9%. I assumed an average sell price of $60 or $60,000, and I assumed a growth rate in unit production of 40% per year. Okay. Now doing this, and check my math, but I calculated the EPS based on the stock price a couple days ago, around 216, and the PE, the absolute PE ratio, calculated at the end of the year. Okay, so you have to, there's some assumptions about growth rate and stuff. Do they miss the earnings here or there, or maybe exceed? Who knows? But this is, I think, a relatively conservative situation for. So I would say this would be my base case. Now, at the end of 2022, first off, Tesla's stock price is no longer $350 a share. It's under $220. Okay, so just that is going to bring that 60, that 58 price per earnings absolute ratio, right, all the way down, right? So by my calculation, Tesla's PE ratio is now under 30, given comparing what I expect their deliveries to be at the end of Q4 2022 to the price right now, halfway through October. Now, if we push out this growth rate and again compare it to the price today, the PE ratios, the earnings are, $10 a year, 14, 20, 28. By the end of the decade, I think over $100 per share on $200 a share. Okay. So by the end of the decade, based on the share right now and their current rates of production, Tesla is going to have a PE ratio under 2. Okay. Now, this is ridiculous, right? These growth numbers are absolutely crazy. Nobody can do this, right? Is anybody? This is what the analysts say, because they're reasoning by analogy. They've never seen anybody do this, but that growth, that exponential growth in the Model Y came from ramping the Shanghai Gigafactory up. Now, the Shanghai Gigafactory at just about full production is making about 1.4 million Model 3s and Ys per year. Now, the Texas Gigafactory and the Berlin Gigafactory have not really started production. They technically started production, but we don't know anything about their deliveries. So if these could ramp up to the same production that we see out of Shanghai, right? That's what, 4.2 billion, I think, which takes us through 2025 and into 2026. Okay. So Tesla can grow at this rate, assuming that they can fully ramp up the Texas and Austin gigafactories by the end of, not even by the end, by the middle of 2026. Okay. But Tesla has a lot of irons in the fire. There are a lot of rumors. There's no other evidence that there's nothing been announced, nothing official about new factories, but there's talks all over the world. There's always rumors that they're going to have a new factory. The Indonesian factory makes sense because Indonesia has a lot of the primary world nickel supply, which is very important into the battery chemistry by mass. Tesla It's going to need a lot of nickel, and Indonesia wisely has decided that they will not export nickel, that the nickel needs to be refined into batteries in Indonesia. So people are going to be building giant battery factories in Indonesia, and that's going to be great for everybody. But there's also talks, potentially Canada, potentially India, and everywhere else that makes sense. Now, one of Tesla's unique advantages is that they're, for engineers, one of the most attractive places in the world to work. In 2021 or 2022, when this chart was put together, or this list was put together, they were the number one. Now they're number two under SpaceX. But in 2021, Tesla received 3 million job applications, and they're still less than 100,000 people. So the talent that they're getting is like the top 1% smartest engineers, right? And so it's a unique advantage. And so they're picking the cream of the crop, and partially they've done this by making it by empowering the engineers there. There's not a lot of as I understand it, the bureaucracy and red tape, that a lot of companies have, where engineers end up, limited because of like politics or something like that. Now, specifically the Teslas, electric cars in general, but specifically the Teslas have amazing safety ratings. There's two things to show on this slide. On the left, that when the autopilot is engaged, there's one crash for every 484,000 miles traveled. No, that's the average. Sorry. The average American is a crash every 484,000 miles traveled. Tesla averages over 4 million miles traveled per crash. So even in the worst quarter of these, which is quarter four of 2022, the Tesla models experienced 7 times fewer accidents per mile than the national average. Now, on the right side, when there is a crash, the Teslas are rated, they're the safest vehicles that have ever been tested, essentially, on the road. So this compares Tesla Model 3S and X to the top 50 vehicles tested by the NHTSA since 2011. The Inflation Reduction Act basically is going to, it's just extra money in Tesla's pockets. Tesla doesn't need this. Their profit margins are already crazy. They have to raise the prices, and they've shown that they can do this. Raise the prices $5,000-$6,000, the last year. And the reason they do this is to control the wait lines, the wait times. So it's, for a lot of vehicles, 6 months to get a Tesla, and if they didn't raise the prices, that number would balloon out to 12 months, 18 months, and that's not good for anyone. So they just raise the prices so that it's manageable. And as their production increases and they can bring the wait times down, they will also be able to lower the prices, which will then exponentially increase the demand. So that is to say, they're already selling every vehicle they make, and without advertising, and they have to raise the prices in order to. It's not their constraint is how fast they can make cars, not how much the cars cost. So this money would go straight in their pockets for every car sold, because they're already making and selling as many cars as fast as they can, right? So anyway, and then I calculated on the right. Anyway, it doesn't matter. Tesla has a design philosophy. Okay, here I calculated on the right just how much that's going to add. It's like 6 billion in 2023, 9 in 2024, 13 in 2025, and 20 in 2026. So this is only on American sold vehicles or American made and sold vehicles. It's not on the total global production. Um, and they were very rough calculations, essentially just made to illustrate, how much, this is. It adds 18 to about 20% to their profit. So increasing the profit by about 20% is the better way to say that. So the Tesla has a design philosophy that this kind of it is one of their advantages, but it also creates more advantages. That the best part is no part, and the best process is no process. So the genius of the Cybertruck, even though not everyone may like exactly what it looks like, I think it's pretty cool. There's not one bent piece of metal on this truck, so there's no need for stamps for forge, except for the the new Gigapress to create the frame, but the actual body of this truck, there's no bent metal. So that eliminates processes. That means there's fewer machines on the factory floor. That means the factory floor is smaller, right? Also, by going with an anodized steel and kind of like it's similar to like Ford when he was like they can have any color they want as long as it's black. Just removing the choice, it's not necessary. It's a rugged, truck. It doesn't need to look pretty necessarily. It's meant to do work. By removing the paint, right, and saying there's no paint for this vehicle, that removes the painting facility, right? That means there's no paint drying time, right? So both of these, right, like it's less on the factory floor. It's a smaller factory footprint, but it's also more units per week, right? It is these kinds of changes are drastically going to increase the throughput and the volume production capacity of a smaller factory, which is what they've done. These factories that Tesla's built, the gigafactories, range from about 1.5 billion to about 2.2 billion dollars. I think is what they've spent on building them, including the capex and everything. Keep in mind, Tesla has about $3 billion in debt, and they're sitting on $18 billion in cash. Okay, so could they build another factory? Like, as soon as they find a good place for it, yes, immediately. They could build, they can afford to build 6 new factories right now with the cash on hand. Like, are they going to do that? No. But they have plenty of money to deploy as soon as they can figure out a way to do it intelligently. And that's what they've said. So back to best parts, no part, best process, no process. The Idra machines, the giant giga presses made by Idra, an Italian company that makes about 10, 11 of these a year. Tesla's buying all of them. So if you want to copy Tesla, good luck. But eventually that's what everybody's going to want to be doing. By having these giant die-cast forge machines, they can make very large, forge very strong structural parts. So comparing the Model 3 to the Model Y, they they turned 171 pieces into 2 pieces, one in the front, one in the back, right? Doing this eliminated over 1,600 welds, right? So how much faster do you think they can make these Model Ys than the Model 3s, right? And how long did it take to do those welds? And were those welds all robots or were there people? But even so, just the time, and then also as an engineer, that is going to increase the tolerances. Everything's going to fit better, right? Um, and then again, this is going to remove machinery from the factory floor, lower the capital expenditure. It means that you can make more units per week, more units per month. It's just a superior method of production. Cheaper factories, more units coming out of a smaller factory. No. Then the other one I just wanted to talk about, because I think this is genius. Oh, man. Okay. So, no, too far. Okay. So the battery here is held in, I think it's 28 bolts, and it slips up onto the bottom of the car, and if you unbolt it, it can just pop right out. If the car is like lifted. Um, so if something goes wrong with the battery, right, or if you need a battery replacement, right, if something happens and the battery gets bricked, right, now you can replace the battery, very easily. It's the most expensive part in the car. You don't want to have to get a whole new car just because of the battery, and so this makes it very clear how they can change that. And moving forward, it's going to be this way, and that's no longer going to be a problem ever again. So very cool. Cost of ownership, it's you don't need oil changes, you don't need fuel filters or transmission, coolant or fluid. There's no timing belts, right? And then also compare the cost of electricity to the cost of gas in this economy. Like, who knows? The macro environment is a crazy place right now. The world is filled with like plague and famine and war. There's inflation, there's deflation. Ray Dalio thinks there's an economic depression coming. Kathy Woods thinks it's deflationary because of all the tech, which is an interesting idea, especially. So anyway. It's rising China, but again, Tesla's current biggest factory is in China, and they're doing great. The Fed might reverse and turn the money printer on, but then that means that people are just going to invest in the stock market, and that's a good signal for growth companies. Now, can the rate of adoption of different technologies, like our electric cars, like how quick could the world really adopt electric cars? Well, look at this graph. There's lots of exponential, examples of exponential growth and adoption of the stove in the 10s, right? And the refrigerator in the 1930s, clothes dryer, air conditioning, in the 60s and 70s, right? The computer, the internet, the mobile phone, all of these things are now totally ubiquitous, but they started as exponential growth curves where in a lot of these cases, it's maybe 15, 20 years. It's maybe 10 years is the difference between, in a lot of these, a 10% adoption and an 80% market adoption. So, where are we in that? But I would argue in any of these markets, Tesla is positioned extremely well by being vertically integrated, by having a bunch of cash on hand if there is deflation and the interest rates, like debt, becomes more expensive to carry. That's going to hurt Tesla's competition far more than it's going to hurt Tesla. Similar, an economic depression, et cetera, et cetera. Now, all of what we've talked about so far is based on Tesla as a car company. Okay. That sounds like the most profitable company there is already. Okay. But there's more than that. Okay. So if Tesla figures out the autonomous vehicle thing, then they have talked about doing a robo-taxi, right? And a robo-taxi network, right? If they maintain ownership of the taxis and then just created their own ride-sharing situation and competed with Uber, except instead of a $15 Uber, where most of the money is going to the driver, there it's a $5 Uber, it's a $5 robo taxi. There is no driver, right? And Tesla is getting a larger share of that than Uber would be. Okay, like Tesla's getting more money off of the $5, and Uber would be getting off of the 15, and you as a consumer are getting a better experience, right? So that's a currently $10 billion market globally. Uber has about 40. It's projected to grow over 300 billion by the end of the decade, compound annual growth of over 16%. So Tesla found a way to do that. I mean, if Tesla figures out the fully self-driving car, then wherever they're allowed to, wherever they can convince the governments to let them, and I really don't think that's going to be a problem long term, they're going to have a more profitable version than anybody else out there, right? So they're going to dominate the global ride sharing market. They're in car insurance. I think that's only because they're only insuring Teslas. I think that's only really to allow them uh, to do the autonomous thing. They're insuring themselves. They believe in the technology so much that they can take the liability on themselves. So that's the main thing there. But they're also getting into energy production, energy storage. The solar roofs are basically as cheap as a new roof. So if you need a new roof, get a solar roof instead. It's the same price. Now at this point, they're limited on. They've basically only done like proof of concept of these products, and because they're very limited on battery production, they've been putting the batteries in the cars rather than here. But as they ramp up more and more battery factories, we're definitely going to see this vertical grow as well. So, as additionally to the home solar and battery product with the Powerball and the solar roof, they also have the large scale utility projects where they'll install, like a whole array of industrial sized batteries to stabilize the grid. So in the bottom corner is a picture of the Hornsdale plant, and in the first year it saved them $40 million, and stabilized the grid and stopped the blackouts issues they were having. So Tesla is going to be able to compete with utility companies, right? And not just that, but like utility companies all over the world, right? So the global utility industry is a $6 trillion industry, 6.3 trillion, right? 6 trillion and 342 billion on top of it, with a compound annual growth of 8%. Okay. And the biggest companies are $117 billion company. Okay. So like all these classic guys, they're constrained to a certain locality, right? And they can't really compete with each other because energy's always been about where you are. But Tesla's going to compete with all of these guys simultaneously. And, they kind of have like a better product, that can, it basically just like empowers the consumer, or it stabilizes the grid, and is a great tool for any of these guys. Right. So, yeah, at first these guys are going to be customers, and then before you know it, Tesla's going to dominate the entire thing. So Tesla recently had the AI Day, AI Day 2, which is pretty much like a engineering recruiting event, but it's also, just, I don't know, as an engineer, it's like one of my favorite days just to see what's, like what's some of the coolest stuff in the world that's happening. Like, so, they showed off the Optimus robot, which is they took the computer chips that they made to do the self-driving machine learning, which is essentially like how to navigate the world, problem. And they put them in a robot running the same software, but it's just got different doesn't have wheels and a steering wheel. It's got arms and legs, but it's running the similar thing, just coming up with new ways to solve the problem based on this body instead of that one. But they showed off a demo of this thing doing work already. Now it's very simple work. It's just picking up, something over here and moving, putting it over here. But that's, useful menial labor. And if Tesla combined it, think about Amazon, it's over a $1 trillion company by market cap. And it's largely like an online store, distribution centers, right? With people picking up things and putting them in boxes, and delivery vehicles. Now, Tesla has autonomous delivery vehicles and robots that can pick things up and put them in boxes. Again, that just seems like a more profitable version of the same thing, right? So I don't think it would be, if they wanted to, very difficult for Tesla to, once the Optimus, is built out more, and that might be 10, 15 years from now, but they could just build their own version of Amazon, and it would be cheaper for the consumers. There would be, less people worked to the bone, and it would be vastly more profitable. So, additionally, they built their own machine learning chips and tiles and computers and supercomputers. They built the sixth fastest supercomputer in the world, to train all of the data, to train their machine learning models on all of the data that's coming in from their 3 million vehicles. Now, the North American machine learning market is only about 6 billion right now, but it's expected to start growing exponentially by the end of the decade. Now, the Tesla, though it's the sixth best supercomputer in the world, it was designed specifically for machine learning, and as such is the best machine learning computer in the world, specifically, as I understand it, if I understand it right, at comparing one frame to another frame and looking for for differences instantaneously. So when you're comparing a video feed, coming from the camera at the front of the car and trying to ascertain that the car in front is getting closer, right? And do it that quickly enough to send a signal to slam on the brakes, right? So that's what it's optimized for. Now, they could do machine learning as a service, okay? And they've talked about this, and offer that as a digital product to anyone who wants to train their models on somebody else's computer, similar to, Amazon, like AWS, Amazon Web Services and stuff. So again, that's another way Tesla could jump in and compete in a completely different vertical, that is very profitable. So key takeaways: Tesla auto revenues are amazing, and the projections are even better. And based on that alone, it's the most exciting company in the world. The PE ratios, when you think of PE ratios, really consider are they talking about a trailing 12 month? Does that make sense in this case? Or should we annualize what they're doing now with an absolute PE ratio? Or, do we think that there might even be, reason for, to calculate in and price in, some amount of conservative